Welcome to the Closing Beat, a live show where we cover the stock market, financial tips to get your dough straight, and sometimes Disney World. Wait, seriously? Disney World? All right then. The Closing Beat, presented by Jazz Wealth.
What's going on, everybody? Happy Wednesday already. How you doing out there? How did I get over this way? Welcome to the Closing Beat. We are financial advisors here at Jazz Wealth, and we got a new year coming up, man. Let's get this year out of the way, right? For God's sakes. It can't get much worse, can it? Actually, we're going to talk about that today, so I'll show you some data on all of that. This will be a short class here today because there's not a lot of good to talk about. And I talked about this yesterday, how that typically means good news for a bottom in the market, but for the moment, not looking too good. Also, this will be our last show for the week. We're going to let everybody get out of here a little early, celebrate the holidays, and we'll, of course, be back in the new year to start this thing over. The market's not open Monday, by the way, so it's a celebratory day for 2023. Anyways, let's talk about the stock market here today. What do we have going on here? We got 2 days left in the year. Is that good news or bad news? Oh, man, can you move it? Like, it's killing me, man. I'm just going to be that little prima donna person there that's like, I think it goes that way. Oh, man, that's looking better. It's looking better. Anyways, you got 2 days left. 2 days left. Good riddance to 2022, right? I want to show you something. So, you know from the chart, there's just no chance. We talked about this yesterday. It's not going to be a positive year, but we're down over 20%. And you know that almost never happens. I've done a class actually for clients where I showed the distributions of returns in the stock market, and we talked about how often you gain the actual 7%. So if you're one of our clients in there, just type in market returns or stock market returns in the classes section, and you actually be able to see it. Really cool. It's just spreading out the data every single year, talking about how things perform. But one of the things I want to show you here, if you're in a research site or you're a research member, you can look at this up and use this tool as well, among others. But if you're not a research member, jazzwealth.com/research. If you want to join, you're certainly welcome to do that. Let's go over here. I'll just try to make it a little cleaner for you. I thought this was fun. Now, the SPY, let me just preface this by saying the SPY has only been around since 1993. The S&P has been around since 1929, October 31. So we can only look back to 1993 for the SPY. I think that's interesting, first of all, because it was the first ETF ever, the granddaddy of all ETFs, the Mac Daddy right there. You're looking at it. That was the first one ever, and the most popular still to date, actually. But let's look at this. How often does the S&P, SPY, lose less than 20% in a year over, really, it's not 50 years, it's 30 years, because that's how old it is. So there you go. How often does that happen? Twice. There's only 2 other times in history we lost 20%. Like, doesn't it feel like there probably should be more? This is not great to be in this, and of course the market sucks and we're all upset about it, but don't you kind of feel like it would have been more if you didn't know any better? Let's take a look. So in 2002, .com into that .com bust also with the Fed raising rates in there, hurting the growth stocks, just like we see this year. 21.5%, very similar to this year. 2008, 36.8%. You all lived through that. It was just not a good time for most people. It was a good time for comedy, because we all needed a little comedy, right? And we could take a joke. But so you got 36%. That's it. What I find interesting is even though that's a limited number of data points, the next year, both had double-digit returns, actually over 25% for both of them. So it bodes well for at least being some kind of positive year next year. It may not be positive enough to erase, I see it very hard to believe it's going to be positive enough to erase all of this year's losses, but that's kind of cool to see, right? Very interesting. Also, let's take it a step further here. How often has the SPY been just down? How many out of the last 30 years would you think it'd be 2 years? We know it's at least 2, right? Would you think it'd be 10? Say like 1/3 of the time we have a down year? That would be a fair guess. That'd be what I would guess. So here's what I did. We did this a little differently here. I'll go back, try to make the, I don't know why I did this like this today, but here we go. SPY down at least something negative. So I just put negative 0.1, right? Something real small percent in a year. And just looking back as far as we can, there's only 5 times the S&P has lost. Does that make you feel better about this year or worse? It's like, okay, this is a rare event for the S&P to be down. Now, this year is going to tick on there as well. So it's going to be, 2022 also down 20%. But otherwise, you have the same 2 that we just looked at. And then you just have 2001, 11%, 2009, 9%, and 4 in 2018, which actually 2018 was an interesting year because we were positive. Then the market fell 20% at the end of the year, erasing most of those gains. So let's take a look. When the market falls double digits, you have a recipe for a rally all but one time. When the market falls and is negative, you have an expectation or a historical probability of an average of a 10% gain, double-digit gains in the next year, and it was positive all but twice, 60% of the time. So that's a little bit of a side here today to talk about the market actually not being down all that often. I would have guessed a higher number. I knew it was a lower number, but if you were you would guess. You didn't have that data. That's what you would do. So pretty cool. Now, as far as the markets go, today what you had was basically nothing good besides a couple bank stocks and Tesla, really. JP Morgan was a little higher on the day. It's been holding up nicely there. Bank of America not holding up nicely, but still just a little bit higher on the day. Citi, I would rank above Bank of America. And then Wells Fargo, ultimately, well, okay, it was flat. Not a whole lot going on there. You had a couple little stocks here and there. Illumina was up a percent. Really hard to find anything that you could get excited about. AutoZone, a fraction of a percent. And then, of course, you had Tesla. And Tesla is sort of a no-brainer for today. We talked about that yesterday. 7 days in a row is not a record, but that's the most it's ever lost in one day in terms of the quantity of days. And so the 8th day, if we were down today, that would have actually been an all-time record. Tesla has never lost 8 days in a row. Being as extended as it is, it's kind of normal for that to at least be a little higher today. That's all you have is the algorithms in there playing that, saying, well, statistically, the advantage is to the upside today. If we're going to do anything, we're going to buy Tesla. So that's all you have there, up about 3%. On the day. Obviously, it's very extended. It's very oversold. Really, really horrible performance here lately. But other than that, it wouldn't matter because Apple making new lows, taking away some of the fun there. Disney being one of the bigger drags on the Dow anyways. In tech stock land, you got Netflix pulling back, Broadcom, Texas Instruments, Alphabet, Meta, didn't matter. The big stocks that have a lot of say in the market today, NVIDIA being another one, they were all down a little bit, and that helped drag the overall market. So there was just no real good chance of there being a decent rally today, and that sucks. They also took down the NASDAQ on the day. It's your worst performer here for the year, and it's going to finish that way. It's not statistically probable that it will come out of 4th place for the year out of the big 4. The Dow is, believe it or not, still the best performer on the year. Looks to finish that way, even though, it's a pretty nasty drop here today. And the Russell 2000s playing with the S&P in that 2nd to 3rd place area there. And it looks to be, that's how it's going to finish out the year. There's a big spread between the Dow on this end holding up okay, the NASDAQ in no man's land down here in the desert, and then the S&P and the Russell in between. So if you were to plot those on a chart, that's what you would see. Speaking of plotting things on a chart, let's take a look. You got oil down just a little bit on the day. It actually recovered kind of nicely before the end of the electronic session there. We got gold. There it is. Gold chopping around, not much there. I'll tell you exactly what's happening right now and what will likely happen for the rest of the year, which is, just a couple more days here. It's called window dressing. And it's not a conspiracy. It's not a phenomenon. Just put yourself in the position of a fund manager or someone like Jazz, right? We manage our own funds here. We don't buy ETFs, mutual funds. We don't make you pay for that stuff. That's how one of the ways we save you money. Well, do I want you to open your statement and see that you have 90% losing positions? Or would I rather have you open your statement and see just that last statement? Would I rather have you see you have 20% losing positions, but the rest of them, hey, wow, looks like they kind of held up okay. That's called window dressing. At the end of the year, if you take from your losing positions, lock in the losses for clients, et cetera, and you move that money to stocks that didn't underperform, maybe they held up, it makes it look like things are better. And it's not really a big deal for us, but for mutual fund managers, if you don't do that, you don't keep your job. So it has to look like things are a lot better than they really were on paper. Otherwise, you lose your job. And how do we prove that? How can we actually prove that that's what's going on in the market? Well, we take the entire stock market and we break them into deciles. You've seen we do that before. We basically take the Russell 1000, which is the top 1,000 stocks, break them into 10 groups because that's the easiest thing for us to do here, and then rank them by their performance year to date. So in other words, on the left, what you're looking at is the stocks that have had the worst performance year to date, and then their performance so far this week. So group number 1 or 10, however you want to look at it, has sold off 2.36% so far this week, and that's the stocks that are already the worst performers of the year, meaning there's a lot of selling happening in those stocks that are already really, really bad off. Second place is the second worst performing stocks out there. They are also seeing selling. So people are voluntarily selling the losers. Where are they putting the money? All the way over here. They're putting them in the best performing stocks. That doesn't mean they're positive, by the way, if they're somehow they gained and then this year, you know, it was a losing year. It means that they look a lot better than these stocks. These are the junk stocks this year that just had a rough go of it. You know, Carvana. And then these are the stocks that held up nicely. And so money is just shifting over here. Now, it's not shifting in the same ratio, so it's not a 1-for-1 split. So what's that tell you? That's tax loss harvesting as well, right? People are selling off their losing positions, taking some of the money and putting it in some of the gainers, but we don't want to get out of whack. We don't want to have, if you have a portfolio that has 10 stocks in it and you have 8 of them that did poorly, or let's say half, I'll go half and half. You had half that did poorly relative to the market and half that did a little bit better than the market and didn't lose so much. You don't want to sell all 5 of those in its entirety and then go buy all 5 of those. You effectively just increased your risk in the portfolio quite dramatically, and depending on the stock, you know, off the charts, really. Now you end up with a portfolio that has 5 stocks, when as a fund manager, maybe your prospectus says that you have to have 10, right? Just to use an example. So they don't do that. So what they do is they say, we're going to sell off most of this stuff. We have to keep some of it because we got to have 10 stocks. Then we're going to take some of that money and move it to the top 5. And we're going to take the rest of that money and we're going to put it in a bond or cash or whatever it is. They can have, I believe, up to 20% in cash. And so if it were a 1-for-1 move, you would see the bulk of this money lifting more of these stocks better than what you see them moving at right now. And you can assign a little bit to just general market weakness, but all in all, it's not a 1-for-1 move. So really, if you're out there trying to, you know, position yourself for the new year, number 1, you're early. You probably should just stop for a couple days. But number 2, you know not to chase those losers. You got tax loss sellers. You got window dressing going on there. It doesn't make sense to try to fight that. It's kind of like fighting the Fed. You're fighting the tide. You're going against the grain. And for the next couple days, that's what you're going to see. We could run this again today. We would see the exact same thing. Run it again on Friday. You're going to see the exact same thing. And then that's it, because it's the end of the year there, right? So window dressing, that's what you got going on over there, and that's a brief lesson on how that works. All right, some of the stocks in the news, if you will. We'll move on here. Apple with the bad news here today. iPhone shipments in the first quarter are projections are being lowered there because of labor shortages, COVID, and the fact that now we've got some of these plants open, and yet people aren't going back to work. Add to that they're trying to transition a little bit over to Taiwan. And so maybe some issues there. It's all speculation at the moment, but that's what it is. Southwest Airlines can't catch a break. Now the government's wanting to look into it. And, you know, it's frustrating what's happening out there, but does the government really need to spend time on that? Do you think there's something systematically wrong with Southwest Air? You do if you're, you know, your flight's been canceled, of course. I understand that. But is there something that's wrong and somehow the government needs to get involved with this? Do you not think that Southwest as a public company will learn from this and say, let's pretend that this happens a year from now. How will we handle things differently? I mean, come on. So nonetheless, that was the reason it was down today. The government's looking into it. It's now a diversion of attention, meaning Southwest can't spend as much effort into, of course, making sure this doesn't happen again. like JetBlue. Remember they had the problem back when Letterman was still on TV? They had the problem. They had to go in front of the Senate. It took them longer to recover from that, and that's unfortunate. I think that's a waste of taxpayer dollars and, of course, a waste of their time when clearly they want to make this never happen again. Like, no one wants to go through that. As much as you might hate them at the moment for ruining your holiday plans or whatever happened. Come on. Just horrible. Taiwan Semiconductors, actually, so this is a lot of this going on. I've been reading a lot about the semiconductor production, inventory, new products and stuff. There's a lot of this going on. They expect, and they're changing their mind a little bit. You might remember, if you watch the show a lot, we talked about their production expectations around their last earnings report. They're now reducing that just a little bit. So they're getting ahead of their next earnings report. That's why you didn't see the stock fall to lows or just start this massive decline, because they're reporting a decline, which means a decline in revenue, but not to the tune that offsets the gains that they'd expected or the growth that they'd expected. So it's not horrible there. It's just on a day where there wasn't a lot of news. Yeah, that's just kind of bad news. And, well, they're going to lose 2% because of it. Last night on our Jazz After Dark, we talked about short-term, long-term capital losses, how they work when it comes to your taxes in a real simplified way. Showed you all the data. We went through it step by step, so you know what to expect when you get your 1099 from your brokerage account. Maybe you're going to see some losses this year, but you know how to handle that, what's going to happen there, and more, just more than just you can write off $3,000 of your losses. A little bit more detail. Tonight, we're going to talk about who gets your Social Security when you die, based on a number of different scenarios. So we're going to look at different things that could happen, meaning you could be already taking Social Security, then die, but have been divorced for a couple years or, whatever. So we're going to go through all those scenarios because, unfortunately, that's something that comes up a lot where people say, it's so confusing. I blank and I don't want to learn about it. Well, I just do it for you. I just do it for you. All right, questions if you have any, and then I'll get out of the way here for you today. Yeah, it's a PR nightmare, but they're going to be fine. They're going to work through it. It's just sad that they got to divert their attention there. Yeah. You think January is going to be bad? I thought Dustin had some statistic about the first week being a high volume week. I don't know, maybe I'm remembering something wrong. No, you're remembering right. Typically, the first week of the new year, and in particular, the first trading day of the new year, is the highest volume year. I started playing with that last night where I took the volume and broke it down by day, but actually I don't know somehow I got distracted. It's one of those things. I start a project and then I push it off to the side and I go, oh, let's look at this, and see what happens. I've been lately trying to figure out what is the actual statistical probability of you being out of a job, right? And then going down that wormhole with all the BLS numbers and stuff. What's the probability you're out of a job, and then by month? What's the probability that you're out of a job for 6 months? Because they say have a 6 months emergency fund. Is that statistically accurate, or is it 7 months? Is it 5.6 months? What is it? So I wanted to go through and figure that out, and then go through and figure, does that change over time? I'm sure it does. I mean, obviously, we could all assume it does, but what is that number variance? Like, is it normally, it must vary between like 5 and 7 months, because people always say have 6 months of emergency funds. Well, rather than just follow everybody else and say that, I'm like, let's come up with the actual number. The data's there. So then I did that, and yada, yada. I got off track there. Yeah. Thoughts on investment grade bonds at this time? Well, so first of all, investment aside, or asset aside, what's the need for that? Why would that be the product that you go to? I don't have a problem with it, but what's causing that move to be made? There's obviously the return expectation. There's the tax expectation, right? So there must be something going on in your life. So that's a tough one to generally hit. I don't have a problem with them now, if you're willing to go that route. But is that the best thing to do? Oftentimes a client will call up, and today was a number of them. I didn't have one retirement question today. Today's questions were all really personal finance related, and everybody had I want to go this way. Dustin, I want to go this way. What's the best way? And I find real quick, I'm like, why didn't you think about that? Like, maybe you didn't know, but why is this not an option? Oh, well, I don't want to do that because I don't want to be a landlord, or whatever the answer is. And so, but still, I'm trying to pull in different directions and see, why did you think that? to start with. If you roll first half is probably more sideways. No, not usually, but I guess anything's possible, but no, not usually. So usually the first part of the year is decent. It's not as good as that last run up until the sell in May time period, but if you're going to say any time period is sideways, you say May to Labor Day, that's actually very accurate. If you roll a 401k into an IRA, should you invest all the money immediately or dollar cost average into the account? Generally, if I had no view or participation in what the market was doing, I would say dollar cost average. I think looking at the market where it's at now, you got to, maybe your dollar cost averaging is spread over a smaller time period. In other words, you do 4 chunks of investments instead of spreading it over the whole year or something. So I'd be more inclined to get in there and participate now because of the discount that we've had, in addition to knowing that the S&P doesn't normally lose 20% in a year. And what happens after that? It tends to try to recover in some fashion. So I'd want to be a part of that instead of just averaging in. Yeah. 203 watching, 35 likes. Yeah, what's up with that? Are you holding Roku? Was Roku the pick? No, I can't say it'd be the pick. I feel that it's going to be tougher for them to be a buyout candidate now because the cost to acquire a company has gone up. Not only that, what'd we go through? Companies don't, when they realize weakness in the economy, they don't go into M&A sort of focus. Remember, that hurts them personally. So it'd have to be like a private equity group that just has extra billions sitting around or something. I don't know. Want to buy some Unilever there. I saw they had a good upgrade. Of course, it was earlier in the year. They had a good upgrade at Goldman Sachs. So Unilever's on Goldman Sachs's, they call it their America's Conviction List or something. It's like their top 40 stocks must have. These are the ones that we feel strongly about. And RJB, come on, that's Alba all day long there. But you got to give me the choice of Hathaway, right? Johansson, Alba, or Hathaway. And then it's a no-brainer. Come on. Now, Morgan Brennan doesn't hold a candle to Hathaway. Now, I don't like Hathaway. It's like Disney. I don't like the attitude there at Disney, but I love the park. Anne Hathaway, don't really care much for her life and views and stuff, but obviously very beautiful. Is that wrong? Do you disagree? Do you know her? Do you know who that is even? Oh, yeah. Well, there you go. Now you know. Is that a little off topic there? Yeah, right. There you go. Oh, RJ's going with Johansson there. Okay. Not bad. I'm just saying. You know. Is your Roth limit this year based on last year's income? No. Well, and now I'm going to assume you're still talking about 2022. It's based on your income this year. So they all go together. 2022's limit. And when you're saying limit, you mean phase out limit, not contribution limit. But yeah, it's based on your income this year. Yep. Can you check out some of those top lists, like the Barron's 10 stocks for 23? Oh, I don't know. Is it? I didn't know they had one. I'm sure they do, but I don't know. Yep. You saw, I've seen, and I don't know, you know how when you like, oh, I want to buy that car, and then you see them everywhere? I've seen more Rivian trucks on the road just in the past, since I had to go in and out for Christmas Eve, than I've ever seen. I don't know if there's a dealership around here or something, but I meant to bring that up to you, that I've seen more of those Rivian trucks around. They're not, to me, they're not impressive, but, that's what it is. Yeah. How fast should you Roth? Not sure I know what you're talking about there. You're limited on, you can't double it up. I think I'm just misunderstanding, but you can't double you're limited on your contribution, right? So that would be that part. All right. Well, I'm going to wrap it up there. Hope you guys learned something, and had a good time today, as best as you can. We will wish you a great New Year's. Hope you have a great time out there. Be safe. Lots of good fun stuff, family, fireworks, all that stuff. Is that what you do? Is that still something for New Year's? Fire? Okay, fire, yeah. Just, I didn't know. Things change around here. I don't know. All right, so we'll be doing the same, and you guys enjoy. Thank you so much for watching us this year. We'll be back in 2023 with more great stuff and something called Project X. Project X, baby. All right, see ya.